Hey everyone, welcome back to the Mark Loeffler Experience. Well, we're going to talk about the world ending yet again. Bank of Canada. Bank of Canada raises rates 1%. And I don't think, let's get this right off the plate. I don't think it's a bad decision. What I think is bad about the whole thing is that what they usually do very, very well is let us know what's going on. Let the markets know what's going on so it doesn't shock the market. And this is something they haven't done. And so we're going to talk about that. We're going to talk about predictions. Is this too little, too late? Is this needed? Let's get into some fun stuff here. Who doesn't love talking interest rates, especially today? Why did they raise interest rates 1%? Well, it's very clear. They got scared. The job numbers came in, even though we lost 50,000 jobs in Canada over the course of a month, the unemployment rate fell tremendously. We're 4.9%, which means, and there's huge wage growth year over year, 5-6%, which again is less than inflation. So most people are getting poorer rather than richer. But anyways, unless they're watching this channel and they're making wise investment decisions. Speaking of which, Monday, July 18th at Caro Restaurant. We'll put the link down below. We're having another investor meetup. We get 40 to 50 people there. It's a good time. We can discuss interest rates. We can discuss what I'm buying, what other people are buying, and what they're doing. So if you're around Hamilton that night, or even if you need to make the trip in, it's definitely well worth it. All right, well, let's just look at this a little bit here. So we know that inflation rates went up massively, right? Like everyone knows that, listen, we've spiked. Year over year, it's huge. We're at, what is that, 9%-ish? 7 to 9%? Commodity prices. So this is what I'm hearing a lot out there is like food prices, oil prices. And then they're actually down kind of year over year. And they're down from the peak of March. So, I mean, obviously you can tell. If you go fill up gas now, you're not spending $2 a liter. You're spending $1.75. Well, that's a 12.5% decline in a matter of weeks. Now, one thing a couple things the Bank of Canada can't control. They obviously cannot control the cost of oil. So that's going to affect the economy. How much, that affects food prices because, farmers use diesel. They use gas and diesel to get the food places, processing, that type of thing. So that's a huge cost in producing food. Obviously we're seeing fuel prices come down. Food inflation has kind of leveled off. It hasn't gone up month over month. I think we've seen peak inflation. I'm going to call it here that we have seen peak inflation. I mean, Jim Cramer, for all he's worth, called the bottom of the market yesterday. I don't know that he's right. But 1% interest rate. So what does this mean? Well, what does it mean for the housing market, which you and I are usually pretty well, we're interested in because, we make a lot of money through it. So number one, what does it mean? Well, obviously anybody with a variable rate mortgage is going to be paying 1% higher. If you're looking at the stress test now, you're qualifying at 6 to 7%. So that's going to have a huge effect on what people can afford. So you look out there and people can afford, $1 million. Now they're going to afford $850,000. So they're going to look at the same houses. They're just going to spend $150,000 less. So that's going to put let's put a heck of a lot more of a brake on the housing market than what's been going on, which it doesn't mean that housing is going to get cheaper. It's not. Your cost of borrowing is going up. Now, just as an aside, should you be buying with a variable right now? They predict that we're going to go to 3.25, which would be another raise of a 0.75 by October. So that'd be a half in September, another 0.25 in October. I think we might go half or 3/4 and a quarter. So I think we're going to end up right in around that range. But let's look at that and say, okay, well, so the bank prime right now is 4.2, 4.3, and you get prime minus 0.55. One thing, though, is you can always lock into a fixed rate at some point. But I think that we're going to see a recession, and they're going to start to lower rates when that happens. So do you now take that variable rate mortgage because you are long-term, you know that's going to work? I think we're back in that category. And if they start offering prime minus 0.9 again, prime minus 0.1, I just don't like prime minus 0.55. I'd rather see a prime minus 9, prime minus 0.8. You know, prime minus, anything minus prime minus 1 or more, I just take that. Oh, what other thing we can't control? Well, the U.S. economy, right? We can't control their consumer goods. I mean, for the longest time, you could buy a truck, drive it for a year, sell it into the U.S. for a couple $1,000s more than you bought it for the year before, and go get yourself the new truck, and you were good. Well, now we're seeing inventories rise of used vehicles. So that's no longer the game. You know, the same thing's happening all over the board with different luxury items, even watches, but like there's just more inventory of everything at this time, which is going to cause prices to come down because, well, let's be honest, more supply, less demand equals lower prices. We've been talking about that in the housing market forever. If they put more supply on the market and even the same demand, well, more supply, same demand equals lower prices overall. But I know people are going to argue with me down in the comment section, tell me, nope, it's those investors. They're screwing up for everyone. And it's not our politicians' fault because, you know, they're constricting the supply of housing they're not doing it on purpose, but they are doing it. And I digress. 1% interest rate. Let's just stay on that. So what happens in this environment? So, okay, house prices are going to go down, but the cost of living is going to stay relatively similar or even go up. Well, rents are going to go up. Cost of goods are going to go down because less people are going to buy them. Less people are going to do construction projects. I was talking to my friend who's a contractor where he would have 4 or 5 jobs lined up. He's now lining up one at a time. So, and he's saying it's because people, you know, they have home lines of credits, but they're way more expensive right now than they were, so they don't want to pay that. You know, obviously the cost of buying a vehicle is going up. So we're going to see less people buying a new vehicle. They're going to either use theirs longer or pay cash or do something like that. You know, your saving rates are going to go up, so you're going to make more savings, yet let's be honest, if you're putting a savings rate or GIC, you're losing money to inflation, right? You got to be lending out money at 10% plus right now to actually make money, a little bit of money on your money. But yeah, guys, I just want to do a quick video today, get this out there, share my thoughts. I think 1% is a good thing. I think they were very, very delayed in doing this. They should have really started June last year and done quarter points. So they're shocking the economy. This is a bit of shock and awe. And I think, yeah, I don't think it's a bad thing overall. I think this is going to stomp on the neck of inflation a little bit, and they're not done. They're not done. I just wish that the Bank of Canada and Tiff Macklin would just tell us what the heck they're going to do. I don't think they know, and I think that's the problem. See you guys all next Monday. Have a great weekend, and we will see you guys soon.